Welcome back to Strongman Personal Finance. Welcome back to Strongman Personal Finance. My name is Christopher Belly. I'm a certified CPA accountant. I'm a long-term boglehead investor. I'm the author of the book Stop Being a Broke Loser. It's on Amazon. And we're going to watch this here video by Jeremy LaFufu, where he describes his perfect stock. And I'm very interested to see the thought process that convinced Jeremy Financial Education to buy titans of the industry, such as Smile Direct Club, Voyager Digital, Tattooed Trucker, Sweaty Putrescent, Shark-Covered Nutsack, and more. So let's go see this genius thought process, because this guy's a millionaire. He must know what he's talking about.
Of the video series, guys. So far we've talked about, why modern long-term investing is the way to go, how to buy and sell stocks, what brokerages to use. We've talked about having confidence in yourself. We've talked about branding. We've talked about income statements, balance sheets, PE ratios. We've talked about all this, guys.
Statement of cash flows? No? Okay.
But how would I judge a perfect stock? What is Jeremy's perfect stock scenario? When I'm judging a stock, what's my perfect stock out there? So my perfect stock.
Oh, highly unprofitable. Oh, massive share dilution. Revenue by revenue.
Is a company that I fully understand. I fully understand that company. I really understand the industry that company's in. I really understand the industry trends that company has, where the company is going over the next few years. Where's that industry that the company's in going over the next few years? I really understand that. I also want to understand fully, why the company is making decisions they are making. Why are they trying to get into that new product, that new service? Why are they doing that? I really want to understand that. So if I understand all that, we're off to a good start. Okay. Now I want to really.
Okay, I'm sure you should understand the industry and, the details of the company you're investing in. Nothing bad so far.
Find an executive management team that really has it together. Hopefully founder-led. Hopefully a founder-led company, or a company that, CEO that leads that company, that led that company out of the doldrums and made it into a great company. I'm trying to find that at the end of the day.
Okay, good management. So far, so good, LaFufu.
Then what I'm trying to find is a company with a great balance sheet. A great balance sheet. I want them to have a lot more cash and a lot more investments versus debts at the end of the day, especially if they're in an industry that relies on that more. And if they're in a more capital-intensive industry that takes billions of dollars to get things done, then I want that company to have a better balance sheet than their peers have. Their peers who are public companies.
Why does he have such an obsession with investments? Like, I get if you're looking at a company's, liquidity. You would look at cash. You would look at cash equivalents. You would look at accounts receivable. Basically anything you could turn and convert into cash pretty quickly. So with him, I don't get the obsession with investments, because investments can be in different categories. You could have trading securities, you could have available for sale, you could have held to maturity. You have to really differentiate that and be specific when you talk about this.
Look at their balance sheets, and does my company have a better balance sheet than their companies? I'm trying to find that. So a company with a super strong balance sheet. Then I'm looking at the income statement. Is the income statement trending very nicely? Are they growing at a better than a 10% clip? Which is hopefully I want, because I'm more of a growth investor, but also value. I also want that net income to be growing at least 10% a year over the last 3 years. And I really want that net income to be expanding at a faster rate than the revenues are expanding. I want
this is where it gets interesting. So I guess this was the old Jeremy that actually looked at profitability. Can you name more than one big company he's invested in that actually has a positive profit margin? I really can't. Honest, unprofitable. Corsair, okay, temporarily profitable because of the pandemic. Tattooed Trucker, Sweaty Putrescent, Shark Sack, unprofitable. Smile Direct Club, unprofitable. Avant Brands, I don't know, I haven't checked that recently. Probably unprofitable. What is this net income growth that you're talking about? And why do you care about 10%? If a company is growing and it's growing its earnings and its revenue, it's really, that's fine. And it's all about the price you pay. You could even buy a company that has declining revenue and declining earnings. And as long as you buy it at the right price, you can get a good freaking return. So just because it grows at an arbitrary 10% or above means absolutely nothing. And if you look at all the companies he's invested in, what companies are getting positive earnings growth? None of them. They're losing money hand over fist. What happened to you, LaFufu?
Those gross margins to be getting better at the end of the day. Then I'm kind of looking at branding. How's that company branded?
Gross margins. Oh, you mean like Tattooed Trucker, Sweaty Putrescent, Nutsacks gross margins that went from like 11 down to 2 and now they're back up to 10? Oh, that's such great improvement.
How strong is that brand really? Or do their customers really respect that brand, or do they just go with it because it's the cheapest thing on the block? Do they really like that company a lot? If it's a business consumer company, or do people really respect that brand? Do people really understand that brand? Are people emotionally involved with that brand?
People got mad respect for Tattooed Chef. Respect, man. I go to freaking Walmart, and they literally have the tattooed chef. I'm not lying. They have the tattooed chef segregated from the other soy boy frozen foods. Where's the respect in that? Obviously, the seller doesn't seem to give a crap about it. Probably get dropped by Walmart.
That's what I'm looking for. If it has that, then we're really looking good. So I'm looking for a company that has good growth, looking for a company that has a strong balance sheet, very strong balance sheet, a lot more in cash and investments versus debts, looking for a company that has an income statement trending the right way, company I fully understand, company as an investor, I just fully understand that company. I know the ins and outs of that company. I know the industry as well as anybody knows the industry.
And it's kind of weird he leaves out this statement of cash flows. I mean, that's very, very important because the statement of cash flows, the income statement is on the accrual basis of accounting. The statement of cash flows actually shows you where the company's money, the actual cash, is going from year to year. How much money are they making from operations? Well, if he actually checked the statement of cash flows, he would have seen that Very Good Food Company would have had to dilute. But he was just looking at the balance sheet by balance sheet, so he probably didn't see that. You could see whether the company's making acquisitions, how much property, plant, and equipment they're buying, if they're paying off debt. Where's most of their cash financing coming from? Is it equity? Is it debt? Is it a mix of both? There's so much on the statement of cash flows that you have to consider when investing. And he doesn't even mention it. Why? Probably because he doesn't understand how it works. Because, it's a little difficult to learn, in like accounting 101.
Where's the industry going? I've got to understand that fully. I have, an extreme amount of confidence in the executive management team there. I have an extreme amount of confidence in the brand that company represents. If I see all those things and that company has hopefully a lower PE ratio than what's going on in the current market, then we're looking at a huge opportunity for me to make a lot of money in the stock. That is my perfect stock scenario. So I hope you guys understand this. This is just, if I'm judging a stock, that is what I'm judging it off of. If all those situations happen, then I'm going to probably make a lot of money in that stock over the next few years.
One thing I completely missed was him talking about managing your downside risk. He talks about revenue by revenue growth. He talks about, having a strong balance sheet, positive net income, which I guess he doesn't care about that anymore. But what about buying a stock at the right price? Because a stock could have 100% revenue growth per year. They could have 120% net income growth. But if you pay too much for the company, you're still going to potentially massively underperform and lose a lot of money. That's what happened to him during the pandemic. He looked at revenue by revenue. That's all he looked at, basically. And balance sheet by balance sheet. And what happened was he paid way too much for these companies. Where's the valuation? The only thing he mentioned was PE. Very, very briefly, which, okay, I mean, that is a valuation tool. But at the end of the day, you have to really understand that you're purchasing future cash flows of the company, and you have to discount them to understand how expensive this stock actually is. No freaking mention of that. Now let's move on to diversification.
Talk about, for a second here, I just want to spend some time talking about something I wasn't even going to talk about, but now I want to talk about it. It's about, portfolio diversification. We hear a lot about diversification. How much should you diversify? Well, how much should you have in this stock versus this stock? So my view on diversification is the older you get, the more diversified you should get. So if you're in your 20s and you're watching this, you should probably be a little less diversified. You can have your money in, let's say 5, 6, 7 companies and you're okay.
No.
Okay. If you're in your 30s and you're watching this right now, you should probably be holding more towards 7, 8, 9 stocks. If you're in your 40s or above, you should probably be holding at least 10 stocks at a time. Now, that doesn't
40s, 10 stocks, you're 20 years away from retirement. You're going to risk your entire retirement on 10 companies after listening to this freaking clown? That's ludicrous. The older you should be in index funds, preferably stock, mostly stock. And as you get older, you should transition part of it into bonds. This clown is telling you the exact opposite. Oh, put your money in 10 stocks. That's sufficient diversification. No, it's not. If one or two of those companies go to zero, which is likely, you had a massive loss from your portfolio that you can potentially never recover from.
Doesn't mean hold 40 stocks. That's too much diversification, because how are you supposed to like stock number 40 as much as stock number 7? That's impossible. That's way too much and way too much to keep track of. But as you get...
Well, funny, it seems like index funds outperform most active traders. So I have 9,000 stocks and I seem to be winning. Weird.
Older, you should be a little more diversified. But for me personally, I like to stay in between 4 and 7 stocks generally for me. I like to stay in between 4 and 7 stocks. That's good diversification for me in my age group. But if I was, someday when I'm 48 years old, I'm going to be a lot more diversified. I'll probably be holding 12 stocks at that time. But right now, I can take a little more risk. I got successful businesses. I got, I'm obviously a very experienced, successful investor. I don't need...
Obviously, he's very experienced. I mean, just revenue, my revenue, and net income, and that's it.
To have my money, in 20 different stocks, because I know that my stock number 2 is going to do phenomenal more than likely. And so is my stock number 1 and stock number 3 and stock number 4. So why would I want to stick money in my 20th favorite investment when that money could be funneled into my 4th biggest investment or my 5th biggest investment, the ones I believe in more? So that's my view on portfolio diversification. And once again, if I just start adding a position and that position goes up drastically, 20+% generally speaking, I'll probably just get out of that position because, generally I'm trying...
Except for Tesla, because that's how you show people that you're such a genius. Oh, look, see how much I made on Tesla through blind luck. Why haven't you sold Tesla? That's interesting.
Get into stocks that are going to be multi-baggers, stocks that are going to be going up at least 100% within the next 3 to 5 years, right? But if a company goes up, in the first week, I own it 25%. That's not as much upside for me. And if there's a better stock I have to buy, then I'm going to buy that stock at the end of the day. So I'm never scared to, I have to hold this stock for the next 3 to 5 years because I bought it. Absolutely not. I don't absolutely stick to that. That's the goal. That's the goal long term. But sometimes it just doesn't work out like that. I just didn't get a big enough position built in that company and it went up a ton. I'll sell it out, guys. I'll sell it out, make my profit on that, and stick the money into something better that I like even better than that, guys. So those are my views on portfolio diversification, buying and selling shares when I kind of make decisions to do that, guys.
Okay, so he makes a 6.5-minute video about his ideal stock, and he runs out of stuff to talk about in 3 minutes. 3 minutes! That's all he has to tell you what he looks for in a stock. This is super basic. Revenue my avenue. Strong balance sheet with investments. And net income growth. This is garbage. Nothing about valuation. Nothing about managing your downside risk. LaFufu, man, you're really charging for this? Anyway, ladies and gentlemen, more to come. Hope you enjoy it. Talk to you later. Cheers!